Imagine if the month most people sleep on became the month that makes or breaks your portfolio. Picture Bitcoin ripping higher while a blue chip burger chain collapses in plain sight. That combo tells us everything about risk, reward, and where to position ourselves now. Stay with me, listen up, and what's up, family? It's Coach Masi. You're locked into the Daily Hodl. This is where we break down the biggest financial news, Bitcoin insights, and market trends so you can stay informed, disciplined, and ready for opportunity. Let's dive right in. Today, we dig into three things that matter to every investor and hodler. One, why November historically matters for Bitcoin. Two, what Wendy's brutal decline tells us about consumer health and market risk. And three, why custody and access, like how Fidelity handles Bitcoin transfers, still matter to your long-term plan. I'll give you actionable steps, risk checks, and what I'm watching this month. Not financial advice, education only. Let's go. First up, seasonality. Traders love patterns. Bitcoin has one of the clearest seasonality profiles in crypto, though September sucked. And November, well, has historically been one of the strongest months, called Moonvember. Let me be clear, seasonality is not destiny, it's context. It's a statistical edge you can use to tilt probability, and your favor in terms of historically. Well, historically, November posts outsized returns for Bitcoin. That pattern is visible across multiple data sets, though it is skewed by a few extreme years, notably early cycle surges. So why might November show strength? Several forces often converge. Macro seasonality, institutional flows that finalize post-earnings or quarter windows, and narrative momentum from headline events earlier in Q4. Combine those with retail FOMO and you have an ignition source. And that would be great for Bitcoin this month. Some data sets show median November gains in double digits and averages that look juicy because of outliers. It's very important. Averages are skewed. Medians and range matter. Expect volatility, expect the unexpected. And think of the past cycles. October can light the fuse and November can be the flame. But remember, 2013 and other early years that drive the average. We're no strangers to big old whipsaws, right? So discipline matters more than moon fantasies. So November can be powerful, but markets do not move in a vacuum. Let's look for clues of where risk might come from. So let's enter Wendy's. If a casual night out is optional for consumers, fast food is often the canary in the spending coal mine. Wendy's has cratered, down roughly 50% over the past 12 months. And that's not a tidy headline. That's a flashing red light I'm trying to show you. Why this is more than a single company problem? Well, fast food is discretionary spending for low and middle income brackets. When the consumers cut back, it shows up first in everyday categories like QSR, casual dining, convenience retail. That contraction ripples to earnings, hiring, and regional franchises. Wendy's specifics, leadership churn, promotional missteps, and slowing same-store sales are combining with macro pressures. When margins compress and comps fall, market multiples get punished hard and the stock is down very much. You see, here's why crypto hodlers like yourself should care. Risk on flows and retail sentiment are connected. If consumers tighten, risk assets often adjust. Institutional capital that chases yield can pause, wallet flows can slow. Even Bitcoin, which has become its own asset class, still feels the heartbeat of macro sentiment. Let me put it another way. Strong seasonality for Bitcoin is a potential tailwind until macro tailwinds reverse. You see, Wendy's is one of those data points telling us to watch consumer spending and inflation dynamics closely. Let me give you some actionable takeaways. Watch CPI, retail sales, and QSR comp reports. One quarter won't break markets, but 3 consecutive quarters of softness change the narrative. If you run leverage, consider reducing it. Margin calls are the fastest way to lose optionality. For hodlers, this is a reminder. Maintain liquidity for opportunities and emergencies. High conviction plus low forced sell risk equals resilience. Also, access matters too. Even if you want to buy or move Bitcoin, platform friction changes outcomes, which brings us to Fidelity. Infrastructure is still evolving. Fidelity built one of the earliest institutional crypto arms, but transfer mechanics and custody features have changed over time. Historically, some big brokerages limited direct deposit and withdrawal flows. Fidelity has documentation on how transfers work and the controls in place, and they've been rolling out deposit withdrawal functionality incrementally. So why does this matter? Well, friction creates opportunity and risk. If a major custodian restricts deposit withdrawal rails or layers on long holds and KYC hurdles, that affects timing and firm flows. Institutions may want exposure but prefer approved custodians. Retail customers can be left with limited options. Also, be careful. Holding crypto at an exchange is not the same as controlling private keys. Even when brokers support deposits and withdrawals, you need to read the terms. Custodial assets, withdrawal limits, network fees, and settlement timing all matter. So here's a checklist. Confirm what your platform actually lets you do. Trade only, deposit only, or full deposit plus withdrawal. Read the provider help pages and terms if you're doing it. If you care about self-custody, plan a secure transfer route and rehearse it with small amounts. Mistakes on chains are irreversible. If you use a broker for convenience, ask, who is the custodian? How is insurance structured? Where are keys stored? So seasonality gives context, consumer weakness warns of macro risk, and custody changes the playbook for access across all security. So here's what I'm personally watching and what you can do right now. Monthly, Bitcoin price action in October was down first time ever since 2018. Velocity into November can be good, but we need to watch whether Bitcoin holds key moving averages and whether exchange flows turn net outflow. As far as consumer data each week, same-store sales from QSRs, retail sales, and discretionary spending. If they degrade further, expect risk sentiment to pressure correlated assets. Now, I dollar cost average into Bitcoin with a plan now. Recommend you do the same and maintain a core HODL stash and cold storage if you buy spot Bitcoin. And then have 3 to 6 months of liquid cash for big opportunities. I'm trimming any levered positions while we watch consumer prints this quarter. If volatility spikes in November and the macro backdrop is still soft, I'll add selectively. I'll set position size, set stop levels, and define my horizon. If you're here for decades, don't let 30 days of headlines force you to behave like a day trader. So I'll ask you, I really want to hear from you specifically. Which of today's topics matters most to you? November seasonality for Bitcoin, the Wendy's consumer warning, or custody access issues at big brokers? Because Fidelity is allowing you to move it around now. Drop your choice and your reason, I should say, in the comments. The best replies will get pinned, and I'll reply. Quick reminder, this is for educational content and not financial advice. Do your own research and consult a professional if you need tailored guidance. I repeat, not financial advice, for educational only. You spend your money how you want. If this episode helped you, though, do 3 things. Like, subscribe to my channel, Lead.Pray.Hodl, and share this with someone who eats, sleeps, and breathes Bitcoin news like yourself. Hit that bell so you don't miss a daily power up. Well, that's your daily hodl. Stay sharp, stay disciplined, and as always, go Dodgers, Game 7. Lead.Pray.Hodl. I'll see you in the next one.